we're not going back to the same economy. We're recovering, but to a different economy. And it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign of what's going to happen to these other workers moving forward. And I talked a little.
One of the things that's interesting about Bitcoin is that it gets less risky the higher it goes. And that's the opposite of what happens with most stocks.
But is there a risk, a regulatory risk here, that there's no way this thing can just keep going and going without government pushback?
I think, we've had concerns all along about various regulatory actions that could have been taken, concerns about the Chinese potential digital currency, what that might mean for Bitcoin. The problem is, as my son says with Bitcoin, you can't cut the head off the snake here. It's decentralized. So if the U.S. government tries to put regulations in that are so onerous for Bitcoin, then the people that would own Bitcoin or want to own Bitcoin will just go to other exchanges overseas that are less regulated and that are more opaque. So I think that you mentioned that series of guidelines that came down from FinCEN. There's been, I think, close to 7,000 comments on that. And I think that while that would be negative for Bitcoin, the market clearly isn't worried about it because that guidance came out 2 weeks ago, and Bitcoin has gone straight up since then. So it may be the case that the people in the Bitcoin market, again, I don't know what everybody's thinking, that to the extent that the government tries to do something like this, it just shows that it's more valuable. Namely, it's something that what Bitcoin is trying to protect you against is the sorts of things that happen in Venezuela or Nigeria or Argentina, where the government wipes you out or confiscates your money, or as Franklin D. Roosevelt did in 1932 or 33, confiscate your gold. So I think it's something that you have to expect that it's going to be very, very volatile. If you can't take the volatility, you probably shouldn't own it. But the volatility is the price you pay for performance.
Welcome to the Crypto Teacher. And guys, I come back with that second video just to make you think. And this one, guys, we're going to go over Bill Miller plus the Fed facilities closing. And we have some good information when it comes to the Fed facilities. But let's get into Bill Miller and the wild things he said, guys. The higher Bitcoin price gets, the less riskier it gets, guys. With Bitcoin going up to these prices, guys, we have to save all these quotes that these billionaires and these investors have made while this price has been going up. We have to save these comments because these comments are amazing. Now, she also asked, did he own Bitcoin? Oh, no, we just have a 5% exposure. Now, guys, a crypto that you believe in is getting less riskier. 50% of your portfolio should be in it, if you really believe that. But then he also said that his son said, hey, if the United States bans it, then they'll just go to exchanges overseas. Guys, what is he talking about? We already have the exchanges banning us where we can't even go to Binance. We have to go to Binance US. So guys, that makes no sense whatsoever. If the United States wanted to ban Bitcoin, it would be banned to us. We know this. That's common sense. So right now, we even see the situation with XRP that hurt the price. Come on, guys. That made no sense whatsoever. When the overseas exchanges were offering 40 and 80% interest on stable coins, they banned the U.S. users on the exchanges before it was rolled out. And guys, do not forget about Liberty Reserve. When they took down Liberty Reserve, that allowed Bitcoin to rise. And Bitcoin rise for a reason, guys. I need for you to open your eyes. You want the red pill or the blue pill? They could have did the same thing with Liberty Reserve. They could have just got out the people that, of course, was doing criminal things and took it over the same way they just did BitMEX. They ran those guys out, put new guys in. It's the same thing. Guys, this is all planned out. But let's listen to another statement Bill Miller made.
So the final point on this bill then is you've kind of ruled out the prospect of a deep correction, said that we already saw that in the first quarter of last year. And because you have to think about this realistically for your investors every day, you know, do you stay exposed, and if so, for how long? What is your price target for Bitcoin? When is Bill Miller selling out, or under what conditions if we're not seeing them right now?
Well, first of all, we own Bitcoin in a partnership that my colleague Samantha McLemore started recently called Patient Capital, and it's about a 5% position in there. But we don't own it in the fund because it's very, very difficult to do that. We're looking right now at the regulatory aspects of that and considering having the SEC give us the go-ahead to do that in our funds. But that's part of the issue on Bitcoin. Bitcoin's got where it is with basically, it's very, very difficult for the average person to access through their normal channels, which is why Grayscale and people like that have done so well. So in terms of a price target, I don't have a price target. I have some price expectations, which I think that Bitcoin from here anyway should probably be up 50 to 100% from here in the next, I'd say, 12 to 18 months. And if you were to ask me the over or under on that, I would definitely say it would be much more likely to be higher than lower. But again, I want to emphasize, you said that I thought the big correction was over. I have no idea what the correction is going to be if there's a correction. We've had 80% corrections. I think if you can't take that, then you probably should not own Bitcoin.
Well, and to your point, if we're talking about that kind of upside, that would be $60,000 to $80,000 over the next 12 to 18 months. All right, so you're sticking with it. It's a perfect time to check in, Bill, after this extraordinary parabolic move higher that we've seen. So while you're here,
now, Bill Miller stated it can go up another 50 to 100% over the next 12 to 18 months. He hurried up and cleaned it up when she said it wouldn't be a correction. He said, oh no, I didn't say it wouldn't be a correction. Bitcoin has an 80% correction for the past 3 times, every time. So guys, he wanted to make sure you knew the truth. And what's the greatest statement he said? If you can't deal with it, don't go in it. So what is he basically saying? If you haven't done your research, you deserve to lose your money. That's what he's saying. A fool deserves to lose his money. Guys, this is nothing but a casino. I need for you to understand this. Next, we're going to listen to Sheila Bair on the actual Fed facilities.
a new piece in the Wall Street Journal criticizes the Fed's corporate debt relief this year, saying most companies benefiting from the Fed's bond buying didn't need the cash to begin with and didn't spend it well either, going as far to say as the Fed's corporate credit facility should be left to die. For more, I'm joined by one of the authors behind this piece. Sheila Bair ran the FDIC during the financial crisis and is now a director at the Volcker Alliance. Sheila, it's great to have you back. And I think a lot of people would say they're wary of the Fed doing this, as a normal matter of business going forward, but that it would have made sense in response to the pandemic. Why do you disagree?
Well, I was actually initially supportive, and I assumed their focus would be on the primary credit market and how allowing large companies who were impacted by the pandemic access credit markets to continue operations. That's not really what happened. The bulk of the intervention was in the secondary market. It was really more of a bailout of investors and underwriters and a boondoggle for a lot of companies issuing a lot of debt, which they probably didn't need. And we've got unprecedented levels of corporate leverage now. So it doesn't. The original idea was to support these companies as employers to continue operations, but that's really not what happened. The Fed didn't put any strings on any conditions on this assistance. There have been massive layoffs, and a lot of the companies benefiting from it, even while some of them are paying dividends. There were no restrictions on shareholder distributions or using this money for executive compensation as well. So no, I don't see the evidence there that it really trickled down to Main Street. It was a huge boon to corporate debt markets, and it also has resulted in a lot of misallocation of capital. I think these low interest rates had already highly favored large companies over small companies, growth companies over value companies. That was just intensified with the announcement of these unprecedented facilities. So I know they were well intentioned. Initially, it sounded like a good idea, but it did not work out that way. And yes, they should be allowed to die.
I wonder if part of the issue is that we're looking too closely at it here, because most of the people who have cited the importance of the corporate bond buying are doing so as it relates to the entire recovery. I mean, a lot of people really pin the whole recovery to that moment when the Fed said, we're going to go beyond just the usual toolkit to this additional measure, because it was really a psychological tell to everybody that we'll do whatever it takes. You know, the famous Mario Draghi line. So, you know, when does it miss the forest for the trees here? Yeah.
Well, certainly Wall Street celebrated it. It was great for the corporate debt markets. I don't have any quibble with that. But is that what we want to use monetary policy for? Right. So I think government interventions, whether through monetary authorities or fiscal authorities, should be geared towards Main Street and labor markets and helping the people who can't help themselves. So, yeah, it was a huge boon to Wall Street and widely celebrated, I'm sure. And again, initially, it seemed like a good idea. But yeah, I think there's real job growth. That would be different. But we're seeing, you know, a weak unemployment report again today. There is this huge disconnect between Wall Street and Main Street. And the overarching problem is we keep relying on monetary policy to lead recovery. And when we get into these difficult times, monetary authorities just simply are not well equipped to get the help to Main Street that has to come through fiscal intervention. And yes, we are distorting capital allocation significantly in the process. People worry about consolidation, big companies getting even bigger. Yes, but again, a lot of that is being fed by quantitative easing into corporate debt purchases. So I do think the Fed, well-intentioned, stand down, back off. Corporate America doesn't need any more help from you. And I'm hoping Janet Yellen and Mr. Biden's new economic team will be very focused on Main Street when they come into office.